So ProVen Legacy is a new company that we've set up really following requests from shareholders in the VCTs to be able to lend to UK SME businesses and provide a way in which individuals can prudently shelter their IHT liability. So we'll be looking to lend to UK SME companies across a range of sectors and stages. The companies will have turnover at least 1 to 50 million, so that there's proof of appetite for both their product and their services, established management teams, and really proof of their success. Well, we know that since the crisis of 2008, there's really been a bit of a liquidity gap, and that banks are only slowly coming back into that. There's a lot of opportunity to lend to smaller companies at attractive rates, but still in a secure environment. And that's exactly the sort of thing that will enable investors to obtain business property relief for their IHT. So my history of lending really has been in the 2 to 5 year period and asset backed. I was originally at Kleinworts as a leasing director, so I've got a lot of experience on that side. We'll either be looking to have direct security over assets or a general security within the company through a debenture, which puts us at the top of the pecking order. It'll either be to acquire further assets or as part of the growth of the business, their working capital needs, but we'll always be looking at the level of asset cover, or if it's what we call asset light, that there is strong recurring revenue within the business. So the businesses will have either fixed assets, test and measurement equipment, IT equipment, possibly manufacturing equipment, or intangible assets in the form of licenses for products. Of course, stock and cash and debtors all form useful assets of the business, all of which you could take security over. No, I think what you're looking at is a very small subset of businesses. So we have, through the Beringea network and our own relationships, contact with a number of companies. So we can be pretty selective in this, and our experience within Beringea and ProVen has proven that. Well, we have a team that's dedicated to debt finance, and we've already been active in growth finance within Beringea, but we also interact with the equity team. It's very much the same sort of companies that Beringea have been dealing with over a number of years. So it's using the Beringea network and our own relationship to make sure that we see the best opportunities for lending. Well, I'm pleased to say that so far as growth finance, later stage lending is concerned, it's only been a success. We've just had a very nice exit, a company that we invested in, lent to back in December 2014, Specialty European Pharma, that has just been sold in May this year, repaid the debt in full, and returned to our investors a return of slightly over 9%. 9% would be more something we would look to achieve on the growth finance stage. I would say on the legacy side we'll be even more focused on the security aspect and making sure that we're not putting the money at risk at all. The key thing really is that you've seen a range of opportunities, so that you know the sort of companies that are out there, you know the management teams that are there, you know what the various balance sheets can look like, and you make sure that you're lending at the secure end of a business. Of course, going with that, you're taking less risk, there's a lower return, but that's the important feature, which is security here. Right, so it's a very good question. There's no hard and fast rule, but my history of lending has really been with repayments over monthly, quarterly. I suppose really from my leasing background, where that's traditional. So we'd expect to have a large percentage of companies that are repaying on a regular basis. That's been the experience within the Beringea debt portfolio. The attraction of that is twofold. One is that you're able to spread your risk more widely as cash is returned and then relent. And secondarily, it can create liquidity if you need to, if you have a redemption request from shareholders. Actually, it's both an income and a growth share option here. We haven't set a rule as to what percentage would be in either. I think we're expecting that people will opt for the growth share, but I understand that some also like the attraction of the income share. And we've targeted a minimum annual return of 3% for both the income and the growth share. With the income, of course, that's paid, and with the growth share, it's rolled up. It's a good question. I've probably tracked interest rates for all of my professional life, more than 30 years of lending, but this has been an exceptional period of low interest rates. Most of our loans currently are done as fixed rate, but given that they're 2, 3, 4 year term with repayments, then I think we're not too locked in. I think that that's something that we will watch over time to see whether we move to variable rate. I wouldn't particularly see the banks rushing into the SME space off the back of that, though. No, not really, because I think we're looking really at a small set within the market. So I think that if you're very hands-on to businesses, you can find enough opportunities that the banks won't pick up. Well, for myself, I'm a chartered accountant. I've had over 30 years of lending experience with Barclays, with Kleinworts, with National Australia Group, and I've got two others in the team with plenty of experience. And for Beringea, of course, we've got a long track record now of acting as an investment manager for primarily, as I said, ProVen and ProVen Growth and Income in the UK.